Welcome to The Explainer. So, you're a business owner. Ever found yourself wondering how you can pay yourself or maybe take on a loan without totally messing up your books? Well, today we're going to break down two of the most common financial moves out there, personal withdrawals and business loans. Nail this, and you're setting yourself up for a much healthier, way more organized business.
Okay, let's kick things off with a situation I bet almost every founder has been in. You need to cover a personal bill, and hey, the business debit card is just sitting right there. It's super tempting, and let's be honest, it happens. But how you record it makes all the difference in the world to your company's financial health.
So, before we can even get into the nitty-gritty of withdrawals, we have to lay down the law. There's one single golden rule in all of business accounting, and it's the bedrock that keeps your personal finances separate from the company's. And that rule is called the accounting entity concept. Now, I know that sounds a bit textbooky, but the idea is actually super simple. Think of your business like it's its own person. It has its own wallet, its own bills, its own assets. Your money is not its money, and its money is definitely not yours. Keeping that line clear is absolutely non-negotiable for good bookkeeping.
And this right here, this visualizes that separation perfectly. On one side, you've got your personal life, your groceries, your home mortgage, your car. On the other side, it's all business, the inventory, the office rent, the company van. We draw this hard line for clarity, for taxes, and most importantly, for understanding if the business is actually profitable on its own. And that's the million-dollar question, right?
Okay, so we've got that rule locked in. Now, what happens when you do need to pull some cash out of the business for yourself? How do we record that move while still respecting that all-important accounting entity concept?
Let's just jump into a real-world example. Let's say the owner uses the company's money to pay their personal rent, which is 2,400 dinar, and then another 600 dinar for household expenses. So that's a total withdrawal of 3,000 dinar. Now the business is down by that amount, and you have to account for it. The key thing here is that money didn't just vanish into thin air. It was withdrawn by the owner.
So how do we put this in the books? It's a pretty simple journal entry. We're going to debit an account called personal withdrawals for the full 3,000. Think of a debit as basically saying, hey, where did this value go? In this case, it went to the owner. Then we credit where the money came from, 1,500 from the cash box and 1,500 from the bank account. Boom, the books are balanced and we have a crystal clear record of that withdrawal.
Okay, taking cash is one thing. But what if you're not taking cash? What if you're taking inventory? You own a hardware store and you grab a drill for a project at home. How do you account for that?
And this is where things get interesting, because it raises a super important question. When you take those goods for yourself, do you record their value at what you paid for them, the cost price, or at what a customer would have paid, the selling price? Believe it or not, the answer actually changes depending on how your business is structured.
If you're a sole proprietorship, it's easy. You just use the cost price. It's like you're telling your books, hey, we never really bought this inventory to sell it. But for a partnership, whoa, it's a different ballgame. You have to use the selling price. And why is that? Well, because if you take something off the shelf, you're not just taking it from the business. You're taking potential profit away from your partners. You're basically selling the item to yourself to keep things.
So check out how a partnership records this. The owner's personal withdrawals account gets debited, just like before. But the credit goes to sales. The business is treating this just like it made a regular sale. And that makes sure the revenue numbers are accurate and fair for everyone involved. Now, let's flip over to the sole proprietorship side of things. It's a much simpler world. Here, the withdrawal is recorded at the cost price, just 850 dinar. And the credit doesn't go to sales, it goes to purchases. This basically reduces the business's total inventory expenses, because those goods were never sold.
All right, so that covers money going out of the business for personal stuff. Now, let's flip the script and talk about money coming in to help the business grow. Yep, we're talking about business loans.
You see, a loan isn't just a single event you log in your books and forget about. It's more like a story with a beginning, a middle, and an end. There are three clear stages. First, getting the cash. Second, paying back the actual money you borrowed. That's the principal. And third, paying for the privilege of borrowing that money, and that's the interest.
So let's break it down and walk through a really clear example to see exactly how each of these stages gets recorded in practice.
Okay, so picture this. Your business scores a 5,000 dinar loan to open a new location. The terms are pretty standard, 10% interest per year, and you have to pay it all back after 1 year.
Step 1, the best part. The money lands in your bank account. This entry is super straightforward. Your cash goes up by $5,000, so you debit cash. But now you owe someone money, right? That's a liability. So you credit a loans account for the same amount. Easy.
Okay, fast forward 1 year. Time flies, and now it's time to pay the piper. The entry here is basically the mirror image of the first one. You debit your loans account to wipe that liability off the books, and you credit your cash account because $5,000 is flowing out. But hold on, we're not quite done yet. There's one crucial piece of the puzzle missing.
And that missing piece is the cost of the loan itself. Remember that 10% interest? 10% of 5,000 dinars is 500 dinar. That's not part of the principal you're paying back. It's a separate business expense for borrowing the money. And this is the final entry that makes everything right. You debit an expense account called loan interest expense for 500. This is important because it hits your income statement, which reduces your taxable profit. And of course, the cash goes out to pay for it, so you credit cash. And just like that, the entire loan story is perfectly told in your books.
And really, that's what this all boils down to. Getting these entries right isn't just about playing by the accounting rules. It's about being brutally honest with yourself about your business's real financial health. Because only when your books tell the true story can you make smart decisions for the future.
So I want to leave you with a question to think about. Right now, what story are your books telling you? Is it a work of fiction, or is it the true story of your business? Because when you get this stuff right, you're not just keeping score. You're taking control of the narrative and writing your own success story.